Everybody, today is Thursday, June 2nd, 2022. We have a lot to get to today, so we're just going to jump right in. We're going to start with economic data. We're going to talk a little bit about oil because oil is falling today on the heels of some potential announcements in July. We had a big interview from Jamie Dimon yesterday. Jim Bullard was talking. That's the Fed chairman, Fed president of St. Louis. He was talking a little bit. We have Facebook news that we're going to update you on that you may have heard of. And then Ford is planning a quote major economic announcement today. So we're going to finish off with that. So we're going to jump in on the economic data. I'll talk a little bit about the data that we got yesterday at 10 a.m., but then we're going to really spend some time talking about jobs number that we got this morning and previewing tomorrow's big unemployment report that we're going to get at 8:30 while we're on the call. So ISM data, manufacturing ISM data. This is the monthly number that comes in that goes around to a bunch of manufacturing businesses and surveys them on how business is going. And that actually went up to 56.1 from 55.4. Now, within that, you had new orders increasing to 55.1 from 53.5. That's good. It was expected to decline. However, prices dropped a little bit, but not a whole lot. There's 82.2 down from 84.6. We were hoping to get a number closer to 81. And employment contracted. This is the big one, and we're going to be focusing on this a lot. Employment was down to 49.6 from 50.9. It was actually expected to go, estimate was 50.9. Last time it was 52. So definitely trending in the wrong direction in terms of employment. On the manufacturing side, we also got the job openings yesterday. They remain elevated, but this is an April number. So they remain elevated at 11.4 million. That's down from 11.9 million in March, but that was upwardly revised. And what we've been seeing with these job openings is that it continues to get upwardly revised. So if we see a similar pattern with these April numbers, I wouldn't be surprised to see about a number close to 12 million is the true underlying number for the month of April. So a lot of job openings right out there, but they're not really getting filled. Today, we have the ADP employment number that came out, and we're starting to see a significant slowdown in hiring and even a contraction in some areas of the economy. Small businesses are ground zero for what we're seeing right now. Small business actually fell 91,000 jobs in the last month. Very small businesses were down 78,000. Overall, we're up 128,000, which significantly underperformed expectations of 300,000. We also had a downward revision for the prior month. It is a bad number. The commentary in the report says the job growth rate of hiring has tempered across all industries, while small business remains a source of concern as they struggle to keep up with larger firms that have been booming of late. The problem is those large firms are not even booming anymore. We're starting to see hiring freezes. Even Salesforce.com that came out with a better than expected number yesterday, they're slowing hiring, which is one of the reasons their numbers were better than expected, because their margins are better, because they are slowing hiring. And I think this employment is ground zero, and we're seeing that reflected in interest rates. We're seeing that reflected in a move for quality in bonds. Tom, talk a little bit about the economic data and how that's being reflected in the credit markets.
Yeah, so really over the last week or so, we've started to tick back up on treasury rates. But what we have not seen is a tick up in municipal bonds. I mean, we've seen munis are on fire. I mean, bonds sold off yesterday. The bond market, quote unquote, treasury sold off. 10-year moved all the way up to 290, 5 years above that at 292. And yet, you look around different accounts and we're seeing as much as 75 basis points, 1% move up in the municipal bonds that we're holding. So people are saying, things have gotten bad, things are going to get worse. The employment situation is kind of falling apart. And so we're finally seeing people move into the, what I would say are the most high quality, cheapest areas of the bond market. People are eschewing treasuries in favor of muni bonds. And the reason is, there aren't as many muni bonds floating around as treasuries. They aren't being, printed or created out of thin air. It's very difficult to create a municipal bond and to get one issued, particularly after 2018 tax changes. And so, we're seeing people move into there, but the credit quality on them is also improving. I mean, just this morning we saw the JEA, which is the Jacksonville, Florida Electric Authority, get upgraded. We saw the Metro DC airports, which is both of Dulles and is it RFK, the JFK, but the airports in DC get upgraded. They're lumped together in one municipal bond issue. So we're starting to see just, this is an area that is sold off really, really hard. It's contracting. It's the smallest area of the bond market. Credit quality is increasing like crazy. And then finally, probably to my own relief more than anybody, we're seeing a break in the bond market where munis are basically on fire. They're up every single day for the last week or so, while bonds are actively selling off in general, or treasuries are actually selling off in general. And so that's really positive news, but it is not good news in terms of where the economy is going. I think it's definitely the writing is on the wall indicator that people would much rather jump into these things, say, hey, I'm going to lock in for 5 years at 3.5-4% tax free, and see where we are on the other side of this equity market.
Yeah, people are fleeing to quality, and it's tough out there. I think that sometimes we can be so focused on what's right in front of us. But if you think about the economy around certain industries, think of the economy around doing your mortgage. Think of when you get a mortgage or you refinance or you buy a home, how many people's livelihoods depend on that. I mean, you have the mortgage originator, you have the lawyer, you have the agent, you have the appraiser, you have the inspector, you have all these things that feed in the economy around just buying a home is huge. And I mean, I've spoken with people in the last couple of weeks who said firms are going out of business now in the mortgage origination side because refis have totally dried up and the purchase market is slow. So that's really tough for those types of businesses. And that's one of the reasons we're seeing some just really chaos on the small business side. So just be thinking about that. Jamie Dimon had an interview yesterday, and he was talking to kind of on the credit side. He said that JP Morgan itself is really bracing for a hurricane. That was the quote he used. He said last week, he said there were storm clouds, big storm clouds. He says he's changing that. It's a hurricane. Right now, it's kind of sunny. Things are doing fine. Everyone thinks the Fed can handle it. That hurricane is right out there down the road coming our way. We don't know if it's a minor one or Superstorm Sandy. So brace yourself. He says that cycles are part of life. They're part of the economy. He says he's a capitalist and these things happen. The thing is to be smart. And like we've been talking about, be smart, be sensible, and be disciplined. Don't try to be a hero. And I think that that's what he's talking about. He did warn about levered loans, which is something that we've talked about internally. He doesn't know if it's systemic, but he says there's a lot of leverage lending out there, especially in private credit, private equity. He says that he wishes there were more public companies. There's just a whole bunch of issues right now. Being a public company, you got regulation, you got litigation, you have all these things that are deterrents of actually being a public company. So that's a detriment. And he talked a little bit about JP Morgan's philosophy on things. He says that higher oil prices are coming. And overall, he painted it wasn't a dire view. I think the word hurricane was bandied about, and I think we've seen a lot of headlines on that today. And if anyone is interested, I can send you the interview. It's 55 minutes. It's a phenomenal interview. He speaks extremely candidly. There is some bad language, so just don't have your kids around when he's talking about that. But I think sometimes it's helpful to hear from probably the most connected banker in the United States who's actually dealing with real people. And it might help just provide a little bit of perspective. But again, he's not panicked, but he definitely warns people, be smart, be sensible, don't be a hero. Tom, thoughts on that?
I mean, I think it's just good advice when you start to see the economy turn like this. I mean, it's almost like the grasshopper and the ants, scenario. Like when things are hot, if you're in the mortgage origination business, you need to be saving that money, because we know that situations like this come around every 10, 15 years. The housing market slows. refinances go to zero and these things go out of business. I mean, it was happening when I was, first coming out of school. I mean, mortgage origination just got crushed. I mean, everything was, in the toilet. And then, these people forget, or they weren't in the industry. They think the sun always shines, and it doesn't. And I think we're going to see that a lot over the next couple of months, especially, if you're a hotshot kid coming out of school, you got offered $100,000 to work remotely for some company that is a non-essential business. You've just been hanging out, kicking your feet up at the house and making tons of money. I think those are the first jobs to go. And I don't think a lot of that money was saved, unless you got in and got a house with a really low interest rate, or if you just bought one thinking, man, I'm crushing it. I'm 22 and a half and I know everything. I think the world's about to get very difficult. I mean, it happened, it feels very similar to when I came out of school in 08, 09, where, I thought I was on top of the world. I had an internship at SunTrust and I was on the fast track, and things got very, very difficult very, very quickly for a lot of people my age. So that's just how I feel about it. I think that Jamie Dimon is right. I think that everybody needs to kind of bat down the hatches and think about what's essential, because, the Fed is out to destroy the jobs market. That's really their only out. I think that the meeting with Joe Biden the other day basically, cemented that. I think that was really the impetus, was, hey, we're going to put you guys in charge of crushing inflation. And when, it really hits the fan and people start losing their jobs, you're going to be the fall guy. That's the deal here. And I think that we're headed that direction sooner rather than later.
Jim Bullard was talking about that yesterday. He said that growth has already been beginning to slow, and that is, quote, expected and welcome. He says that once inflation gets under control, we could get back to 2019 levels in terms of interest rates, which would mean fixed rate mortgage coming down to about 4%, 10-year coming back down below 2%, which would actually be an extraordinarily good environment for fixed income if you can buy some fixed income now. Point here being, just finishing on Dimon's comments, again, I don't think it's 2008. I think that there's a huge middle ground between 2008 and what they call garden variety recessions. I don't want to be glib when I talk about garden variety recession, because it's a recession. No one likes when the economy is in decline, but it doesn't mean everything's 2008 where there's systemic risk when there's banks coming out. It doesn't mean unemployment's going to 13%, but it could mean it goes to 5-6%.
Yeah.
So I would just couch that there's a huge middle ground there, and the credit situation, especially on the company side and on the public company side and on the consumer side, is much better than it was 2000. Totally different.
Yeah. I would say that it echoes, it doesn't rhyme, right? It's a very similar environment. If you're coming out of school, it's going to be far more difficult to get a job that pays like people who had, gotten jobs in the last 5 years. I mean, I'm sure I've talked about it on this show before, but one of my really good friends, he was a year ahead of me. He went to Georgia Tech, got a job at Microsoft, moved out to Seattle, and has never missed a paycheck as an adult. I was literally a year behind him, and it took me years to get to a point where I was making a sustainable income. And it was all about, he graduated, in 2008, I graduated in 2009, and it was just that one, he was one of the last guys in the door. Everything went terribly. Microsoft didn't hire anybody after him for years, and he just is the last guy in the door. And some of that timing, I think, is going to be very detrimental, through no fault of their own, for a lot of kids coming out of school right now.
Yeah, I agree, especially with rent prices going the way they are. I think it's going to be tough for them. But I wanted to kind of get your thoughts, Tom, on this Jim Bullard stuff. Thinking that the policy rate could come back down at some point in 2023, 2024, once inflation's under control. Now, he's looking very far ahead, because we're certainly nowhere close to getting inflation under control right now. But it's interesting that we're already starting to see people talking about cutting interest rates when we're in the midst of it. We're about to hike by another 50 basis points in 2 weeks.
Yeah. And I just wonder, there's some sort of internal messaging that we're not receiving from the market at large. They seem to think or know something about inflation coming down more quickly than anyone else. If they were being more aggressive, if they say, hey, we're going to do a triple rate hike, next meeting, and we're going to just go hard in the paint until something happens, then I would say, yeah, then we'll probably have to cut rates sometime soon, because inflation will come down. I just don't see a scenario where that's really the case, unless they get really aggressive. But they're already talking about pausing interest rate hikes in September at the Jackson Hole meeting. They really haven't raised rates that much. We started the balance sheet runoff yesterday. And I mean, even if you look at the ISM report, price action came down, but it didn't come down even as much as they were estimating. So we're seeing inflation come down, but we're seeing it come down, in a very, very nominal way. It's not, falling quickly. It's not going from 8 to 6. It's going from, 8.5 to 8.1. And it's like, I think they need to be more aggressive. They're more aggressive than maybe this happens, but I just don't think this is a realistic outcome.
I agree with you. I think that I think the Fed is running a dangerous road here by looking at some of these statistics in terms of total output. So when you think about total output, that is your inflation plus your actual real output, and that'll give you your headline number. Now, when you strip that out, you break it into its component parts, you break it into an inflation component, and you break it into a real growth component. Now, if that headline number is coming down, it could be because inflation is coming down, but it could also be because real growth is coming down as well. And in the last 2 weeks, we've seen the Atlanta Fed take its GDP number from 2% plus to 1.3%. And so we know that real growth number is coming down, and that's coming down rapidly. The inflation component, though, we'll know a lot more next week when we get the CPI number on Friday. So that'll be an interesting one, and that leads up to the Fed meeting on the 15th. Switching gears a little bit, we're trying to get a hold on inflation. Part of that, the Biden administration is trying to exert a little bit more pressure on Saudi Arabia to pump more oil, and it seems like they may be doing that. There was a note out of a source from OPEC Plus today that said they will potentially increase the output by 600,000 barrels a day in the month of July. That's up from an expected 400,000 barrels per day. So that would be a good news on supply. Biden has a little bit of a history, though, with the Saudis. When he first came into office, he said that he wasn't going to be meeting with the Crown Prince, MBS, instead, because he blames the MBS for the 2018 murder of Jamal Khashoggi. But MBS controls basically the supply of oil in the world. And so the thinking is that Biden is going to meet with MBS actually at the end of this month in an olive branch and a desire to increase the production of oil. Georgia is in the enviable position of having the lowest gasoline price in the United States right now. So good for Georgia. Part of that's helped by Brian Kemp's 30 cents a gallon elimination of the tax, of the gas tax holiday. So we have $4.19. National average is $4.72. Just for perspective, California average gasoline price, this is an average, is $6.21 a gallon. $6.21 for 1 gallon of gas. And you're not getting far on a gallon of gas in Los Angeles. Tom, any comments on this, how this is going to impact inflation? It seems like this is good news. Oil is down today, but will that continue?
I mean, it's really tough to say. I just don't think it's enough. 600,000 barrels is not nearly as much as you think. It sounds like a lot, but it really isn't in terms of, daily use.
It's 0.5% of global consumption.
Right. So, I mean, if you assume we've been running at a deficit for, call it 6 months now, you're really only getting back, a couple of days worth of production for the whole year at this rate. I just think that there's just too many pieces moving in the oil space right now. I mean, until we get some sort of resolution on Russia, until we get some sort of resolution here in terms of drilling or expanding on oil leases that, some of these big companies have, I just don't think there's going to be a lot of relief. I don't see an end on that. But the upside there is the higher oil prices go, the more demand that's going to suck up, the more dollars that would be going other places are going to go there. And that could potentially bring down inflation despite, being a piece of pushing it up. So it's definitely something we're keeping an eye on. It's not ideal. I personally am pretty angry at the Saudis for stealing Dustin Johnson from the PGA Tour for their new upstart competitor in golf. But, that's really my little axe to grind.
Last two things we'll hit on really quickly. Sheryl Sandberg is leaving Meta. Facebook is changing its ticker symbol to Meta next week on the 9th. She's been the COO at Facebook for 14 years, really credited with expanding a lot of the advertising business. It will be a shakeup at the company. I think the biggest thing that remains to be answered is how will Zuckerberg's leadership of the company look now? I think when it's been the two-headed monster of Zuckerberg and Sandberg, that's been one thing. When it just becomes Zuckerberg, he can get distracted, and he has been distracted in the past. Sandberg's often brought him online. Question is, does he have that sufficient maturity at this point in his career? Sandberg will remain on until September to help with the transition. She will remain on the board, but she will not be involved on the day-to-day business. Ford plans a major economic announcement today at 9 a.m., so just in about 10 minutes or so, talking about how it's transforming its global automotive business and accelerating development and scaling of its electric and connected vehicles. There will be a press event at 10:30. I don't know, man. I think that this could be, and through no fault of its own, but Ford may have bungled the timing on this when it's connected with a ADP employment report like we just had.
Yeah. I mean, they're so heavily tied into unions. They're probably going to have to cut off jobs sooner rather than later. I think unlike maybe last year when GM did their major economic announcement around electric vehicles, it'll be a little bit worse received. I mean, last year electric vehicles were so hot, everyone was feeling awesome. Everyone was talking about getting one, and maybe could have afforded one. But I just feel like it's a little bit of a bad timing situation, to roll out a bunch of, high 5-digit, low 6-digit vehicles at a time where gas is so expensive that, people probably won't be able to afford buying one, even if they wanted to.
I hope that it ends up going well for Ford, just for the overall economy and for people and jobs. But it could be one that we look back on and say, man, all-time case of bad timing.
Yeah.
So, all right, we'll leave it there. Sorry we went long. Tomorrow we have the big jobs report number. So please be with us. We'll try to be a little bit more brief, but big number that we'll be focused on. Thanks.